We're starting to get some of that data that the Fed's going to have to see before they make their next interest rate decision in September. It is Wednesday, August the 5th, and this is Markets with Megan. If you like this podcast, you can subscribe, hit the alarm bell, share it with your friends, family, colleagues, anybody who's interested in the economic data that they read about and what it means for the economy and the asset classes. Well, today we got the reading on July ISM Services, and we like to look at this indicator because the majority of money that American consumers spend is in the service sector. So the service sector is very important to remain strong in order to keep the economy going. We got the reading today, and it has been in expansion territory now for the past 2 years. It was slightly below expectations, but again, this is where we like to dig into the details because that headline number doesn't tell everything. First of all, let's look at what caused the decline in the index. It was mainly because of the backlog of orders and then also supplier deliveries. But this is not a bad thing. It means that some of those supply chains were easing. So when they're easing, that number detracts from the headline. When they're increasing or getting more supply pressures, it actually adds to it. So it's not a bad thing that we got some easing of that supply chain pressures. But what we are looking at that the Fed's going to pay attention to is that while overall activity was strong, we saw this kind of yin and yang here with the prices paid component and the employment component. The prices paid component jumped up again above 70. It's now been above 70, which is a very high level on a historical standard for the fourth time in the past 5 months. But at the same time, we saw that the employment component actually did fall back into contraction territory. And it's actually been below 50 in 12 of the past 18 months. The indicator, some of the results coming from companies was that they're able to meet the current demand without actually adding to payrolls. They're using AI, implementing that to have instead of hiring new people. And then they are shifting to some lower cost locations. So this has been a negative for the labor market. And this is the two components the Fed needs to look at. Can they balance keeping the labor market strong with also either raising rates or trying to bring that inflation level down? And right now we're seeing those prices emerge again as the war has restarted here in July. The other thing as we mentioned, the industries, there were 17 industries that actually reported higher prices. So none of them reported price decline. So this is broad-based inflation concern the Fed needs to take a look at. That's all we have today. We'll be back. It's a big week from a labor market perspective because we'll get the big jobs report on Friday. But we'll be back, and if you want a history of our podcast, you go to marketswithmegan.fm. Thank you.